Let's get to David Pearce, who is Director of Strategic Initiatives at GPS Capital Markets. David, I don't know if you want to weigh in on the conversation we're having, because it goes to the heart of central banking here. Just what do you do? How aggressive do you get when you've got fiscal policies from governments as well?
Well, I mean, the hard part about that is everybody is kind of out for themselves right now. I mean, the U.S. government versus the UK government, they've got really different goals that they're trying to accomplish. And unfortunately, I think that when we're seeing this really strong dollar, you mentioned earlier the U.S. dollar index is really hitting a high spot right now. That makes a lot of commodities way more expensive around the world, because a lot of gas and oil, fuel, things like that are priced in U.S. dollars. So if the U.S. dollar continues to strengthen, that can incrementally hurt countries in Europe and Asia, much more so than it does in the U.S. And I really like your comment about how you've got different parts of a government working against one another, because they've got different goals that they're trying to accomplish. And I think that when you start looking at the fuel and the cost of utilities that are going to be coming up this winter, that's a big concern for everybody.
David, the market this week has been looking very closely at the dot plots and wondering what happened to the pivot. But to me, there was a lot of messaging from some of the central banks here in Europe. I mean, the Riksbank telling us that you're going to go higher in rates and they just stay there for a long time, a number of years, possibly 3 years, which is somewhat of a shock. But then on the other side, we've had Norges Bank effectively telling us you get these jumbo-sized rate hikes out of the way, and then you have to slow them down because suddenly demand is falling away and you can't continue at the same pace, even if you've got inflation well above 6%. What's the messaging for you now from the Fed and what investors should do?
Well, it's interesting. One of the things that you mentioned there about what's going on in the UK is how they are trying to reduce taxes to stimulate growth. Kind of sounds like old, Reagan trickle-down economics from back in the 80s. And if we look at the just runaway inflation we had back in the 80s, what the Fed did to combat that is they increased interest rates dramatically. And a 0.75% hike was like a tiny one. They had no problem raising interest rates dramatically to overcome inflation back, during the Volcker days. So I think that we have not seen the end of, big interest rate hikes, because there's so much pressure, inflationary pressure out there right now. And it is so uncertain right now that I think that we're going to see more hikes continue. And I wouldn't be surprised if this hangs on for a while.
David, we're a similar vintage as well, and we remember the old days. I think that's a nice way of saying we're both fairly old. But experience, seasoned like a good whiskey or something, I don't know. But the point being is, we remember the bad old days of currency wars, currency intervention, battles between speculators in the early 90s, and every currency under the sun, namely the pound, under a lot of pressure amongst others as well. My point being is, those days, there's something coming in the water. Maybe some of these currencies are beginning to say enough is enough. And I thought the BOJ yesterday was fascinating. I know you've got some views on this as well.
Yeah, Japan, intervened for the first time in, 24 years or something, that they finally have intervened against the U.S. dollar to try to strengthen the Japanese yen up a little bit, because they're really struggling to pay for things because the yen is so weak. The one that I think is more concerning to me than that, and Japan has got a lot of U.S. dollars just sitting in the Fed. They've got a lot of U.S. treasuries, but China, I think, is the real wild card right now, because it's really getting out of control for them, and they have got so much in their war chest of U.S. treasuries that if they start dumping those on the marketplace to strengthen the Chinese renminbi, I think that we could see some dramatic changes globally. It could really destabilize a lot of the things that are going on in the world.
Let me take you back to the subject that we were focused on. You were talking a little bit about China and your concerns around China. We had a guest on earlier on the program from SocGen who said the biggest worry is the Chinese economic model is now broken. I mean, we've seen in the French PMI data there what a little bit of government stimulus can do for growth in France. Clearly it gets some traction. But I think the concern for China now is that whatever the government does, however the People's Bank of China stimulates, it will not have the same effect as we see in Western economies. Give us your read on that.
Well, let me kind of finish my thought that I was talking about if the Chinese government goes and starts selling off a bunch of bonds. If they start selling treasuries, that's going to kind of flood the market. If the market floods, the Fed has no choice but then to continue to raise interest rates at a pretty spectacular rate. So that's the thing that I'm really concerned about when we are talking about the Chinese opening up and their coffers and starting to sell their bonds. When we talk about the stimulus on a local basis in China and why that would not react the same as it would in Europe or the US or other places in Asia, is it is a different type of economy. And the people there they spend a little bit different than we do. They are not as consumer oriented as we are in the Western part of the world, and they do like to save. But at the same time, they are very much a speculative country. The people there like to speculate, and they like to look at new things. And so just putting money into the economy is not necessarily going to create the type of growth. The interesting thing that you mentioned in the statistics coming out of France is that they're trying to control inflation, but they're also stimulating growth. And when you put money into an economy and you're trying to reduce growth at the same time, that's kind of counterintuitive to one another. And so this goes back to the same thing we were talking about earlier. There's counter forces going on in the marketplace right now.
David, I think we're all worried about the recession risk at this stage. But as you look at the data, there's not confirmation yet that we are in recession, and there are still some areas of strength. And if I look to say high yield paper, perhaps as a canary in the coal mine, it is still relatively well behaved. We haven't had the blowout in spreads that you might expect that would signal a deep recession. Is that just because the market hasn't caught up with the reality, or is it telling us that actually we might just squeeze through this one with something short and shallow?
Yeah, and here's part of the deal is I think that we have not quite caught up with demand. The whole COVID and manufacturing being down and not being able to get the things that we need to. I mean, for instance, car manufacturing still has not caught up with the demand. You cannot go out and just find a car, at least here, sitting on the lot. They just don't exist. You have to wait months and months. I've got a friend that I work with that's been waiting 16 months for a car that he ordered brand new. It's a simple van. So there is some pent-up demand, and so when I look at my companies that we work with that are manufacturers, they still have really good demand for their product, and they're expecting a record year this next year because there still is quite a bit of demand. When we look at my clients that are more in the tech world and the software and people that are creating apps and things like that, there has been definitely a retraction in that world. Because that's the kind of thing that you don't have the pent-up demand because you can duplicate software immediately. You don't have to manufacture that. There was plenty of that in the marketplace. And so that's where I'm seeing most of the slowdown is in things that are not physically created items, the software and things like that. But when you start talking about the hardware, cars, physical things, there still is quite a bit of demand in the marketplace for that. So I still think that there is a lot of industry and a lot of companies that still have a lot of leg room out there.
I hear you, and I'm sure everyone in Utah drives around in Hummers anyway, let alone vans, and they've delivered, 400 in the first half of the year, and they've got reservations for the electric Hummer. I think it's 90,000. It's crazy. I'm sure it's not a van your friend wants. I'm sure it's another Hummer or F-150 or something.
He's got a wife and a bunch of kids, so he needs a van.
Definitely a Hummer.
I drive the truck, so that's what I drive.
I drive an old truck at home as well. I love it. Now, look, in terms of a completely different sector, I've been talking about Credit Suisse. We interrupt you to tell you about how this stock is trading at record lows today as well. How sit the banks more generally for you? Do you have any preferences on the US financials, which have definitely weathered the storm better than European? But from here on in, the banks, of course, critical at a time when we've got spikes in inflation, spikes in interest rates, and possibly spikes in delinquencies.
Well, and I think that the biggest concern that I'm seeing in the banking sector right now is the capital requirements. With the huge increases we've seen in interest rates, that puts a big burden on banks to meet capital requirements because you now have bigger spreads there that they've got to cover. And so that's where I am seeing the biggest talk right now with my, the people that I know in the banking world. That's what they're really concerned about. And they have been backing off on lending because they're worried that they don't have enough capital. And that's what we're hearing with Credit Suisse. They're out there wanting to raise some more capital because they're not being able to meet those capital requirements. That's the big concern in the banking industry, and I think that should be a concern globally right now.
David, I want to bring up FedEx because that was a big one for the markets too, and we saw, of course, concerns around its statements about a worldwide recession, that its revenue preliminary numbers would be a challenge. But what we saw just in the past 24 hours or so was stepped up cost cutting. Is that a signal that that is the phase from here, from corporates to hold the line? We're just going to see a wave of cost cutting.
Yeah, it feels that way right now, but we also need to look at the change in the way that the markets are structured right now. FedEx, if you look at how much they used to ship of Amazon products, Amazon is now taking over most of their own shipping. So we're seeing kind of a logarithmic change in how that industry is structured right now. And if I look at the trucks that are out on the road right now, I see lots of Amazon trucks. I'm not seeing nearly as many FedEx trucks. And that doesn't mean that there's lack of demand for shipping. It just means that more people are doing things through different channels. Now, going back to what you were saying about are people cost cutting, yes, we're starting to see more people laying off people, trying to reduce excess. But I really think that right now, there's really not a lot you can do from an employee standpoint to reduce costs because most people are desperate for workers. They've increased the amount that they're paying people because they have to, because people can't afford to live because of the inflation we've got going on. So there's not a lot we're going to be able to do from a cost-cutting standpoint.
Let me ask you about inventories, David, because as you look around the manufacturing sector, it does seem that there is evidence of a build-up in inventories in some parts of the manufacturing area. And I think we saw that from some of the big box retailers, how they are a little concerned about inventory build-up. What does that tell us, if anything, about the supply chain challenges from here on in?
Well, interesting that you should say that. I was on the phone with one of my clients that sells a product into big box retailers just this morning, and they were telling me that this is looking like it's going to be their best year ever, and they just had their best month ever. They sell into like Lowe's, Home Depot type of stores, where they are getting tremendous amounts of orders from. And they're getting them earlier than they used to. So their product is mainly sold in the wintertime, not only for the Christmas season, but onwards in the wintertime. So they're pretty bullish on orders themselves. So they really haven't seen a downturn. They've actually seen an increase. And part of that was through the COVID years, they had a lot of extra product in those stores. And so their orders had gone way down because they were trying to burn through the product that they already had in the stores. And now they're seeing that they've gone through all that product and the orders are looking tremendous for them. I'm sure that that's not the case everywhere, but it was just interesting that just a few hours ago I was talking with a client about that exact same thing.
David, I hope we haven't ruined your Friday night, keeping you up so early in the morning. Thank you so much for joining us. David Pearce.
No, I love being on with you guys. Thank you.
We would be ships in the night, we're in the same place, but this aligns perfectly. David Pearce, thank you very much. Director, Strategic Initiatives, GPS Capital Markets.